Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, January 12th, 2026. It is 11:44 a.m. Eastern Time. Website's back up and running. If anyone tried to access it this morning, we were down, had a error on the server, had to troubleshoot with the hosting company tech support folks for a while. Usually they get those up and running pretty quick. Either way, we are restored for now. They said there's a possibility the error that was caused could pop up. I'm going to have a developer look at the files, the troubleshooting logs. But either way, we're good now, at least as I'm doing this video. And if you hear the video, it should be good. Here's what we're going to do in this one. I'll talk a little bit about the VIX and the equity markets. And again, this bears repeating because all the comments tend to be about the stock market, the majority of comments. The stock market, which I'll get to in 1 second, has been again in a sideways range, going nowhere for a while. Yes, you'll hear the headlines talking about the Dow, which is a what do they call it? Price weighted index, which is absolutely asinine if you read up what that is. That's why you don't see me covering the Dow. The Dow is the most antiquated index, especially with that price weighted index, meaning basically if you have a $500, $800 stock in there, that has a 10-time weighting than an $80 stock, has nothing to do with market cap. So the S&P, NASDAQ 100 are your, more representative of the market and better tradable indexes, and they are market cap weighted, meaning the bigger the company is by market capitalization or size, which is if you add up all the shares of the stock out there, that's your market cap. And that's the weighting there. And of course, I always say the NASDAQ 100 is a more concentrated view or performance of those market-leading big mega tech companies that really pretty much are the drivers of the U.S. economy and the stock market. The Mag 8, Meta, Apple, Microsoft, Amazon, Tesla, and the likes. All right, we're going to do today is, again, I'm going to do a follow-up video later. There's quite a few trade ideas that are close to breaking out. And again, we've been in a sideways range, but as I mentioned, we've had a lot of stocks, even not just in the past couple months, the last couple quarters, while we've been in that range, both long and short trades, hitting multiple price targets, a lot more hitting targets and stopped out. I'd say the success rate on the official trade idea is probably tracking easily north of 70, if not 80%, which, the way to make money in trading, if you had a 50% success rate, right, or 51% success rate, and you used a 2-to-1 RR, a 1-to-1 RR, you'd be making money. Risk $1 to make $1. You have to bat just over. You have to have a little bit over a 50% success rate. And so typically the way trading works, and that's why on my trade ideas, you'll notice some have much larger or wider risk-reward ratios, some have smaller. And what I tend to do is the more aggressive trades have higher profit potentials. Give yourself a little bit wider stop often on those. Natural gas is a great example. Bitcoin, because they're very volatile. And not always. Sometimes I will keep stops tight on those if it's depending on the trade. For example, a catch a falling knife trade might have a little tighter stop than another trade. So at the end of the day is again, this is generally speaking, the more favorable of a risk-reward ratio. That is, again, how much unit of risk to your profit potential. A 2-to-1 is typically the minimum I'll use, meaning I will risk $1 to make 2 in profit to my price target. 3-to-1 is ideal. You're risking, $1 of loss or 1 unit of loss again to 3 units, or 10% loss, stop loss on a 30% profit potential. And again, some trades will go up from there. They're all, again, depending on the chart setup. And so what I mean by that, if you buy something, let's say, that fell to a very, very good support level, you might have a very high price target if it turns, if you're trying to catch a bottom at that long-term support. But if it goes much below there, then the stock may crater, right? So therefore, you don't give it that much room, or I don't on those particular ones. All right, so that's kind of a general thing. And what I'm going to do is talk a little bit about active trading here. Even day trading. Most of what this site is about, 99% of the trade ideas and things I cover, are typical swing trades and longer term trend trades. A swing trade, Again, it varies on the security. Some have explosive charts. So quite often we'll hit a initial price target within a single day, or maybe one trading day, or even a few hours. Double-digit gains. Again, some things are explosive, but generally speaking, it takes about I swing trades. I usually say the holding periods are measured in days to months, but I are generally around 6 weeks. And guys, again, that depends a lot on market conditions. So we're going to start out here with the VIX, and because when the VIX is low, that tells you volatility is low. Therefore, usually swing trades are going to take longer to play out. So here, let me just show you again to reiterate the stock market, or the main index that I often trade and track. Here's QQQ. We are the NASDAQ 100, and let me turn off all the lines. So as of this moment today, we are just a hair above where it peaked in this trading range back here. And if you look at the pop-up box to the left, that was 3.1 months ago. So we are, or do it this way, over 3 months ago. If I go up to where we are today, right now, we're up about a whopping 1%. So again, and yes, the S&P is a little higher because financials are carrying that. But again, if I turn on my boxes, this is the range that we've been in, and then you can see the Dow, which is that price weighted index. That's the one the media forever and a day they just harp on. Again, it's habits. The Dow, to the best of my knowledge, was the original index back in the day. As modern stock markets were evolving back in the early 1900s. And again, it's very antiquated in my opinion. So trade it if you want. If you ever want to chart their Dow futures and all that stuff, and they're probably liquid enough, but you get more liquidity in the S&P 500 futures. All right, so that's it. So to recap, there's an uptrend line. If that breaks, we're at the top of the range. My preference or expectation or preferred scenario, however you want to call it, not that must play out, will be a break of that trend line, take us down. In other words, any new high is, including Friday's high, I predicted would, well, hold on. That didn't take a soothsayer to predict that any marginal new high would be a divergent high. What I said is it would be guaranteed to be a divergent high because the indicators would not be able to take out their previous highs on any marginal new high. You go up a lot more, you take out the divergences. Divergences aren't the be-all, end-all, but they are a big part of my trading style. So that's it. And right there, we're still holding there. So, to say that the breakout has failed, again, it is a bit subjective. You can be literal if you say, okay, well, that was the breakout right there, and if we go below there. But here's the trading range, give or take about right here. And it is, by the way, not unusual to see a breakout to new highs instead of a perfect back test of those highs rallied. Quite often they'll undercut the highs, kind of blow out some of the stops, and then go up. So the way it works is, yes, any move down below this level here, about 6.9, that's about 688 or so, is a failed breakout. You're going to be back into the trading range. And the way it works is incremental, but steadily increasing. That the further you go down into the range, the greater the chance is that breakout has failed, and we're going to go back down to the bottom of the trading range. And as I've been saying for a long time, this trading range is getting very long in the tooth, and it's going to break one way or the other sooner than later. Is it possible we continue to grind around here for another few months? Yes, anything is possible. But history shows, when you look at consolidation areas, trading ranges, that they, depending on where you are in the cycle, they don't last forever. Rarely do they. So that's it. And now we're going to go down to how to make money in this environment trading market. Because again, you're going nowhere if you're a buy and hold or even a swing trader, trend trader in the equity markets right now. So we're going to go back to the VIX now that you kind of know where the market is, and look at the VIX. So the VIX volatility index, typically when the stock market corrects during, again, the more impulsive or sustained a correction and or bear market, the higher the VIX goes. So it's almost almost, not always, but usually an direct inverse correlation to the stock market. But what we do know is the big, the turns, significant tops, in other words, corrections and bear markets in the stock market begin with the VIX down off its low levels. And the VIX is not it's not a specific range bound indicator. What I mean by that, down below you see I use often the RSI is a range bound indicator. It could never go above 100 or below 0, and it doesn't hit those levels, but it approaches them. But they're, it's bounded due to the way it's calculated, and there is no upside limit on the VIX. But if you just take a look at history and go back as long as you want, which we're doing here, you can see that the VIX pretty much has a fairly well-defined low end of the range that it gets to and a high end of the range. So these are your bear markets along the way. There's the financial crisis right here. There's COVID right there. And these are the recent corrections we've had in recent years right there. And you can see on my weekly chart, I was on a monthly a second ago. This is where bear markets used to end. This was the dot-com bubble right here. We had a bear market from early 2000 to 2002. Over time, and that's one thing I do in my analysis, something that worked for 100 years or 20 years may not work anymore, or levels and things change. So I'll analyze a chart, and so pretty much it's pretty clear to me, since the financial crisis, which ran from late 07 right here to March of 09, we entered a new era where the VIX tends to get higher. And we've had, most will agree, this was the last real bear market, in my opinion. These were the last two. Then you had COVID. Again, I call it Ursa interruptus, meaning that, my made-up Latin term for a bear market that was interrupted by massive monetary and fiscal stimulus around the world. And either way, but that ended it. That was the end of that one there. And since 2009, this is where corrections have ended, this level here, including these last two, right? So the next real bear market, it's reasonable to expect the VIX is going to go up all the way back here to about this 88, 89 level. And then let's talk about the bottom, because we're a lot closer to the bottom than the top right now. So just like the stock market, these divergences, typically you're going to get positive divergence on the lows. These corrections and bear markets end with a bang usually. Bull market tops, whether it's just for a correction or the end of a bull market and start of a bear market, they're typically processes. And those processes however you say it, processes take often months or years to build. Kind of like, think of a super tanker turning in the ocean. It doesn't turn like a speedboat on a dime. It makes a slow arc, takes a while to turn. That's how the markets top. So therefore, the bottoms, you're going to get these divergent lows that you can see here marked. And but the end of bear markets, like COVID, like the financial crisis, they usually end with kind of a meltdown, quick bang, and then massive stimulus and everything else from the government, central banks and all that stuff. And then boom, you get an explosive move. So that's it. And also, just a takeaway, if you've followed me for a while, you've heard this. It's been my experience that the VIX will peak before the stock market bottoms. So I've said this often. When I'm long the VIX, I'm usually closing those out a little bit ahead of where I plan to close my index shorts out. And then once I'm confident the bottom's in, I'll close those index shorts out, reverse go long, and also, if I'm not already, I'll short the VIX and then ride that thing back down after riding it up. So all I could tell you, this is the most recent divergent low. We're still above it. And the VIX remains elevated. Let's drop down to a daily chart. The daily chart's a little bit busy, but bear with me. If you followed me for a while, we've had longs on the VIX at all these divergent lows in recent years. I believe I don't think we've missed any of these. And more recently, we put in this new marginal and still divergent low. So there was a divergent low. I had been harping on this uptrend line for a while, in the last several months, as you recall. Right here, we came to it, we took it out, and if I said we took it out, I had a couple support levels. This is a big long-term support zone, still very much a possibility, and we're probably going to go here if the stock market's going to rally and go up another 10+%. That would be my best guess. However, what I can tell you has happened, this recent drop off here. Remember, the end of the year, if I said it once, I said it a million times. Take breakouts, breakdowns, pretty much anything that happens with a big grain of salt. That's just my experience. And between Thanksgiving and New Year's, volumes plummet, traders on vacation, year-end position squaring, window dressing, all that good stuff. And you tend to get a lot of whipsaws, meaning false breakdowns, false breakouts on individual stocks, the markets, etc. And so what happened is the VIX did break down below that level, the uptrend line, but it has recovered it. So this is what I wanted to point out. One of the things today is that is a bullish technical event. When anything breaks support, especially a well-watched, well-defined support level, and then recovers it, that's one of the most bullish things that I've experienced in trading. And my logic, it's, again, not anything I've ever read. It's just something I've observed, and it happens time and time again. There are no guarantees with any of this stuff. I speak in probabilities, not possibilities. So it's a good probability that this was a bear trap. And the reason that these kind of things, in my opinion, are bullish for the VIX, that is, bearish for the stock market, is that short sellers pile in when they see a break of support. And as someone who's just as comfortable shorting as going long, I know where if you take a breakout or break down below trend line, then your stop should be, you should recognize that you were wrong, that the breakout failed, was a whipsaw if you recover that level. So that's what's happened. All right, so I'm going to get to the indexes in a second, talk about levels, active trading, even day trading for those interested. So I just want to point that out there and tell you that breakdown, just like, again, this is not mere coincidence. Just like I predicted any new high anytime soon in the stock market would be a divergent high. And not only that divergent high would most likely fail. Same thing has already happened here in the VIX and the S&P 500. S&P 500, you can't say the breakout failed yet, but you can say that one here. Now, this is also right here, this level. Let me give my blue color tool. It shows a little better. That is a nice support level. We've had a couple brief drips below, but that one was a false breakdown there. See, it was nice support, right? Divergent low, and that was followed by a move of about 120%. Actually, more than that. I'm sorry. Let me grab. That's about where my crosshairs are, about where that started. Before all is said and done, from that false breakout, it was about a 370% gain in the VIX. All right, divergent low there. And so that's it, guys. I'm not going to spend much more time on it. I also want to talk, you can see here what's happened. These Fed rate cuts seem to be catalysts. This one here, and this one here. They appeared to be catalysts. Shortly after the Fed cut rates, the market corrected. So we'll see. This time around, we had an initial blip, another leg down. All right, let's get to let's go to the Qs for talk about active trading. So the kind of the bigger picture, not the longest term, not the monthly or weekly charts. I've covered that quite a bit. We're still in this within the trading range, my purple box. We're in that symmetrical triangle on QQQ. And we've been testing the top of it for the last few days, and we're right on that. On the 60-minute chart, recently I posted we had a breakdown, which was a sell signal on this trendline break. We had comparable trendline breaks on SPY and QQQ. We're looking at the 60-minute chart of QQQ. If I don't mention it, let me do something here. Change that color. Let me change that box tool from red to cyan. All right, right here, it says QQQ hourly. It also says 1 hour. And then even here, it says 60 minutes. So if I forget to mention what time frame we're on, you can see it right up here on the left. All right, so that was a sell signal. We're back to we bounced back to where we started. Again, this is here it is. The day of those sell signals on the 7th. That was last week. That's where I posted them, and I just got back to my desk when that happened, I believe. Yeah, that's it. So I had us going first to 618.38 with a reaction. So I'm going to talk a little bit about active trading. And again, it's, right now, remember, we're in that trading range. So as long as you're in the trading range, what tends to happen is you're going to get more bounces off these initial support levels if and when hit. So that was the first one. We're going to 618.38. It wasn't a big drop, but I'll speak to that in a second too. How to trade that. Right here. All right, this is the current chart. So from the sell signal down, it was, as I mentioned, about a 1.2% drop. You might say, is it even worth it? 1.2%. I make a lot of terms up in trading investing. One of those terms I've made up years ago is called velocity. It dawned upon me pretty early on, and one reason I like swing trading, active trading, sometimes quite often I'll do day trading, is velocity is a term I came up with where, let's just say hypothetically, you can consistently make 5% a week, right? That's going to be, multiply that out. There's 4.3 weeks in a month, but let's just say 4. So we're just at 20%. And then 20 times 12, you get the you can do the math there, 240% a year. Again, assuming you could just make 5% a year. So it's that get in, get out quick kind of thing. And if you get 1% on a day, you get 1% the next day, you're tracking to that 5% a week thing. All right. And I'm just using a number. Markets aren't always going to be conducive to active trading. And there's times when the VIX expands where all of a sudden these, I'm not looking anymore for a 1% move, because then volatility goes up and the NASDAQ 100 is going up and down 3% a day is the norm once the VIX starts to quote unquote wake up, when it starts to get to higher levels, volatility will expand. Just like it is in silver right now. Silver is regularly going up and down 5+% a day. That's the new norm for silver. For the last 20, 30 years, rarely did you see silver ever go up 5% in a day. So recognize the conditions, set your, and trade accordingly. And so when volatility is high, you're going to be on the indexes, that is, you're going to be targeting larger targets. And when you're in a trading range like we are now, we're both in the sideways, the box that I drew on SPY and QQQ, as well as within that triangle pattern. We're getting close to breaking one way or the other from the triangle pattern, at which point I expect volatility to expand. And therefore, when that happens, we may smash through some of the minor support level / targets on this chart. So to just, again, quantify it, 1+%, another 1% on the bounce. And just to show you where we're at, that was a divergent high right here. We made an equal, if not marginal new high, doesn't matter if it's equal or marginally new high, as long as you have indicators making, which they are, continue to make lower highs, that is negative divergence. So just like that was an objective short entry, that was an objective level to cover for an active trader and go long. And if you're wondering again, well, okay, I get your whole thing. How do you make, money 1%? You're not going to get them all right. What I do when I'm day trading is, that's almost all traders use margin. So you can margin up. And by definition, if you're using an index ETF, you have that overnight risk. Futures, you don't have it unless it's Friday, because the futures will shut down at the end of the week Friday, not open up again till Sunday night. But other than that, they trade around the clock, 23, 5.5, right? 23 hours a day. There's a shutdown period every day from 5 to 6, and then that's it on Monday through Friday. And other than that, and they pick back up Sunday evening. Whereas the future or ETFs, you're prone to gaps. You're going to see a lot of gaps in QQQ because the futures can move overnight. And so it's a little harder to keep a tight stop. All right, so I just want to point this out, that if you have currently the skill sets or the inclination to actively trade, That's where the money is, and you can take a shot here. I wish I had a better trend line. Like that was a sell signal. We don't have a that was a sell signal, and you can say it's still in play because it was a divergent high on this 60-minute time frame. We've had one, two, that's right here, three, and that's just an equal and still divergent high, three divergent highs in the last few months within that trading range. I'm going to measure them out for you. The total drop from high to low was about almost 8.5% on that one. This one was about almost 5%. And so it would stand to reason that this one could be anywhere between there, and quite possibly more if and when this trading range finally breaks out, especially to the downside. So I'm going to talk about the sell signal because it's a divergent high. If it was a divergent low, I'd be talking about upside targets right now, right? If we're coming off that. All right, so there's that. And then I drill down to the smaller time frames when I'm actively trading. And that would be the 15-minute chart. This was an official trade we had here. I gave you a total of 6 targets. All 6 were hit. Then we had a divergent low. We were long after covering all those shorts right there. And then you can see here, we had a divergent high, a little shot across the bow correction, but we made a marginal and still divergent high. Then came the bigger drop that ended with a divergent low, trend line break, divergent high. Again, you can see the pattern here. It's very, very clear. So the only part that's not crystal clear is divergence in itself isn't a sell signal. So you try to find trend lines, horizontal support levels. What we had here was a breakdown and 2 back tests of this uptrend line there, and then the rejection. Here you had a trend line breakout. And right here, again, I already gave you the sell signal was based off this. I had a trend line on that 60-minute chart. Remember, this is a different time frame, so I have different lines on this chart. That was their sell signal, and we're back to the same point. You could have gained that bounce off the first target, and now I have a new uptrend line that a potential one, I call it, because I say potential. I like 3 distinct reactions to confirm a trend line. Sometimes that's all it takes, or the 2. It's just the more you have, the better. That's all. And you can see here, we only had a couple, and then boom, breakdown. So that would be it. And again, 15-minute divergence as well. So, and down to the 5-minute. 5-minute is a great time frame for very active traders, especially day traders. And again, I'm not condoning or recommending the use of margin for anybody, especially new traders. But if you're just recognizing those ranges and you just want to go for those 1%, 2% up and down moves, they do add up. And a great guide is your 5-minute chart. There was a divergent low right there. That was, probably 2-3%. You can measure it out. That was a nice bearish rising wedge pattern with a divergent high. I don't have the labels there, but you can see my divergence lines, right? And drop. That was a nice divergent low. So this is just a easy, not somewhat, can be at times very easy roadmap for just navigating even within a trading range. So we're getting a little granular here. When I go down to the 5-minute charts, and I'll even use 1-minute charts when I'm day trading, 1-minute trend lines to trigger buy and sell signals, or when to cover long or short positions. And then I'll give you the futures real quick. NQ, NASDAQ 100. And one other tip I'll pass along, I've said this many times in the past. If trading, let's say you don't want to get, not familiar with, comfortable with futures, you don't have a futures account, don't know how they work, read up on them, learn about it. There's some nuances you need to understand, difference between ETFs. But I always watch, especially during the regular trading session, the charts of QQQ as well as NQ, even if I'm trading NQ, the futures. And I'm going to get to in a second, I also watch the charts of the top 10 components of the NASDAQ 100, since they have such an impact due to their market cap weighting. I want to see as many of those stocks confirm what I see on the charts of QQQ and NQ, whether I'm bullish and going long or bearish and going short. If a lot of those are unclear or even pointing the other way, maybe Nvidia's poised, maybe I'm ready to short the NASDAQ 100, but Nvidia at that point popping above a bullish falling wedge pattern with big divergences, and it looks like it's going to run, I'm not going to short the NASDAQ because Nvidia will alter the course of it. All right, so there's 60-minute chart of NQ. Nice clean up trend line, nice steep bearish rising wedge, breakdown, little kickback rally. Nice drop, another wedge, divergent high, drop, divergent low on the RSI, rally, divergent high, and then we've made an equal. We kept testing that divergent high. This is where your first divergent point was. Second, we just extended it and then dropped down into that divergent low. You can see we had a trend line break there. There's a divergent high with a trend line break there, sell signal, RSI. Sometimes you just get the divergence on one, not both indicators, and again. So you can see we've been pinching. Now, that triangle on QQQ on the daily is a little more clear, and that's the one I'm putting a higher weighting on. On this 60-minute chart, we've had a couple false breaks, getting a little sloppy in here. And when I see a security go through a trend line multiple times and back down into it, I put a lesser weighting on it because it's too many violations. Now, it may still matter, but it was only a minimal trend line, 1, 2, 3 distinct reactions up to this point. So I'm not putting a huge weighting on it. I do put a higher weighting on these divergences. And again, this is just an extension of that same divergence, at least here on the PPO indicator. And you can see we have clear divergence on the RSI. Okay, so that's it. And if you are using margin to enhance, make that 1-2% quick swing trades worth it. If you're trading, again, if you're using QQQ or anything where you have that overnight risk where the futures could tank and there's not the liquidity or the after-hour sessions closed, day traders by definition close a position out at the end of the day, so they don't have that overnight risk. So especially if you're leveraging up on those day trades. And then ultimately, trading the indexes long, short, it's all about trading around a core portfolio, even in a swing trading account, of positions both long and short. And that's one thing we've had numerous trade ideas, and we still do long and shorts right now. Probably more longs overall on the site at this point in time, just from what I've been finding in the charts lately. In fact, I just had an alert go off. I haven't even checked it yet. You might have heard the buzzer go off a couple minutes ago. Let me check that. That's NFE. This one here, pushing against the trend line. So I shared this one as an official trade idea with a buy signal to come. And so when I get these alerts, I look. And right now, one of the things I'll look for is the volume above average. What are they doing? Are they starting to buy this? There was a little spike there, but we're not clearly above it. So I'd hold off at the moment and wait to see what I want to see. And I can tell you now, looking at it, this is where I first shared the trade idea, was somewhere over here. We have this area right here. You can see these recent highs. So you really want to see this high get popped. That high that day was 130. We're at 125 now. That's most likely. I bet if I looked at level 2, you'd probably see a stack of orders sitting above 130. That's where they need to pop it right there. That big green candle, which was also a bullish engulfing candle, but didn't come at the low. That one was a bullish engulfing. But either way, I'm looking at this trend line. So I just want to point that one out. Keep an eye on it today. That may go. We have a couple that are pushing against trend line support. I think, what was it, one of those healthcare? I gave you a couple of them recently. Humana. We already had a trade on UNH. We had actually 2 this year. This is a great example of being a flexible trader. This was an official trade idea. I had a bullish falling wedge coming off a divergent low. I can't remember. You can look the trade up, whether we bought it at long-term support. Was that it? Or did we buy it on a break? Yeah, probably on a breakout of the bullish falling wedge, this downtrend line. And then we went up. We hit my third and final target. Gapped above it, so you even got a better fill on it. Anytime you have an individual stock you should have on your, on your every trade. I'm a big proponent of OCO. One cancels the other order. You have a standing order to sell at your sell limit at your price target. In this case, the final target. If you gap above it, that's where the order's filled on a sell order, sell limit. Sell limit orders will fill at the price or better. And so when you gapped above it, that's where we filled. And then we sat back, closed it out, booked the quick, what did we make on that? 30 something percent. And then wash, rinse, repeat. And then I saw it at backfill at this gap right here. So we shorted it, I believe, there. We hit my first and second targets, turned to 30 something percent. When I remember, we were out of it, but that was a new trade, another 15% on it. This, my friends, is swing trading. Now, the stock is testing that rejection there where we shorted it was on the 200-day moving averages and that big gap resistance. Now it's pushing against the 200s. If it pops those, we could go up. We've already backfilled the gap, so that's been checked. That's how I kind of see things in my mind's eye. That resistance, the big gap, the backfill has already happened. It increases the odds if we take out the 200s, we're going to go through there, and you'd see this would be your next target. Now, that's not the one I wanted to cover. We have a MOH. We're already long this one. We entered right here. I just updated the other day. We hit T2. Somebody asked my thoughts on it. You can look at that on the site. It was in one of the recent comments. But there's another one. Yeah, Humana. So obviously they're all in the same. These are healthcare plans. You can see my theme here. Been bullish on these guys. Bearish in the case of gaming the pullbacks, after we've closed out the longs. But this one's also ready to pop right there above R1. So, and again, that's how my mind's wired. I wanted to share that I had NFE is getting close, and this one can pop. Yes, I started the video telling you the market might go down. That's my preference. But again, I trade what's in front of me. If I, might have looking for a pullback in the market, which would be a pop in the VIX, by the way. But at the same time, spreading my bets here, and these are healthcare plans. These are defensive issue. They have nothing to do with the NASDAQ 100. I don't even believe any of these companies are components of the NASDAQ 100. So, best case scenario, if I'm lucky enough, and remember, they say it's better to be lucky than smart, right? But if I'm lucky enough, the NASDAQ goes down, profit there. The VIX goes up, profit there. And then these guys go up as well. But again, pending, we need to see this pop. We need to see if Humana breaks out and UNH takes out the 200s. And which other ones did I have for you? MOH takes out T2. Then that's, it's birds of a feather. It shows the sector is getting some traction. Let me extend that uptrend line. That was basically a breakdown and backtest at T1. And then you can also see, again, if you're new to the site, if you're not, you already know this. These are, each of my targets are where you're likely to have a reaction. I define a reaction as one of two things or a combination thereof. A reaction, if you're going up and you hit a resistance level, a reaction can come in the form of a pullback. I call that my hacky sack or a ping pong thing. You drop a ping pong ball on a concrete floor, it's going to bounce. Or my hacky sack analogy. If you're going up, you hit a target, you can also consolidate on that level. And that's the more bullish of the two as far as a reaction. And sometimes it's a little combination there of a little pullback, little sideways action. And that's healthy, normal action, price action in a stock that's going up. When it gets too far ahead of itself, it needs to take a breather. So that's it. So I just wanted to share the current state of the markets and the fact that, again, to reiterate, starting back where I was, no trading range lasts forever. And if you are in that active trading mode, you can use the 5, 15-minute charts, 60-minute charts, everything I just showed you. This is SPY, the S&P 500. There was that comparable sell signal I gave you recently. Breakdown, we're marginally above it, still diverging, and therefore my expectation remains the same. That this breakout to new highs in the S&P 500 will likely fail. You can see right here, there's where it fails, and guess what? If it doesn't, then those long trade ideas are probably going to go up. And as I pointed out, every long that we've hit price targets on and for months now, or shorts. By the way, we've had a lot of shorts hit price targets with a market going to new highs. Can you imagine what happens to the other active short trades if and when the market starts to correct hard, then they will outperform. But my point is the individual stocks, especially this is the environment you want to be a stock picker. And I really honestly believe wholeheartedly 2026 is that's going to be defined as a trader's market, not a buy and hold market. And that's where you're going to earn your keep there is trading stocks. The most bullish setups long, the most bearish setups short, spread it around, and you will probably significantly outperform the stock market. And then that's not even to mention the other asset classes, precious metals, commodities, crypto. Again, long, short, depending at the time. All right, I'm going to wrap it up here, get the video out to you guys, and then I will I'm going to continue to hunt for new trade ideas. I haven't gotten to any comments since Friday. I cut out a little early on Friday, so I'll get try to catch up on the comments. And this whole morning I've been working with tech folks trying to get the site back online, and hopefully we have no more bugs there. And if we do, just know that throughout the week I'm checking it. I didn't know if it went down over the weekend. I don't know. I just went to log on this morning and saw it was down. All right, guys, I'll get this one out to you and try to get back to all the questions as soon as I can. This has been Randy Finney with the Right Side of the Chart. Have a great day.